Hi there, everybody. It's great to see you in our room today. This is Craig at Max Trading, along with Chris and Eusebio. And truly, we have been looking forward to a new type of webinar experience today. You are actually the very first traders to experience it. And so we really appreciate you helping us out just by being present today. If you were in last week's webinar, this is not a repeat. It will be different. And we'll be looking for some participation from you as well. It was more than 4 years ago that Eusebio got started on developing and testing what we now know as the Max Enhanced Trade Format Indicator. We call it the ETF. A lot easier, right? It has proven itself as being tremendously effective as an addition to max trading methods. And we are now ready to incorporate ETF into all of our courses. Every max course will feature the ETF. So whatever level of max training you select, you will also get the ETF indicator, and you'll be trained in how to use it. This will give a huge boost to your confidence as a trader, and it will provide you with a way to dramatically increase your results. And as I mentioned last week, even with this upgrade, tuition rates are not, repeat, they are not going up. We're keeping exactly the same tuition even for the upgraded courses, as Chris will show you a little later. As the developer of the ETF, Eusebio is the perfect choice to tell us more about it and show us what it does for max traders, and we'll get to that soon. But first, Chris has some really important information for us, so all the way from New Zealand, here's Chris. Thanks, Chris.
Hi, everybody. Can you hear me okay? Let's just make sure that my sound is coming through all right. I'm just waiting for... Cool. Thank you very much. We'll show you a bit of difference between the what the ETF method is like versus the classical Jim Pruitt's max method, and show you what's involved in the training that we provide you, and what's kind of required from you to become proficient at being able to trade the max. A little bit about the max. We've been training since Jim Pruitt started the max up. Dr. Jim Pruitt, he developed the basics of the max method, the standard, the classic version, in 2007. Unfortunately, he passed away in 2009, and we kind of honor him by having the tiger peeking around the side, watching over us all the time. He was a bit of a grouch and liked ripping into people, and so he had a nickname of Tiger, hence the tiger on the side. So he's always there looking at us. So since 2007, we've had over 1,900 students. I think it's about 1,950 so far. It's a bit hard to keep track of them, that have done the courses, and we are still supporting even the very first ones that are around. This is the 55th series of courses, and I'll show you what we've got available. It was, in the past, primarily a trend trading method. So if there was a movement, once a trend was established, we would capture it and start trading it, and using Jim's ideas and some of Eusebio's refinements that he's built in on top of the max, we're able to milk the trend for as much as possible. What Eusebio has done, and thankfully Eusebio was around, he was able to refine Jim's training. Some of it was a bit hairy, made it a bit safer, and has over the years has added more features to it, and it's continually being refined. One reason why people keep taking the courses. So it will do trend and now counter trend, so both directions at once. It can catch reversals at extremes, and because of some of Jim's techniques, he did something which produced something which max standard people know of as the TTs. You're able to see where the very extreme of the price is, so that you can take a really nice exit, and there's an example of this coming up. And as a result of Eusebio's ETF, you can catch longer moves. So rather than just waiting for the trend to unfold, you can get into the move almost at the very turn. If you want to do it that way, you can still trade just the trend until you become comfortable. but you can catch much longer movements, and you'll see what the result of that is. And these days, this is one of the reasons why we're incorporating ETF, is because the ranges in the markets these days are very, very tight. There's small ranges. For instance, the pound yen used to be around about 600 to 800 pips on average per day, and these days we're lucky to see 150 pips per day on average. So it's very tight, very hard to trade these days, and as a result the maxes tighten things up where we are much more precise than we were back in 2007, 2008, when if the market moved you could just kind of make money out of it if you did things correctly. These days you have to be very precise about what you're doing. So the courses that we've got available that we're promoting today are the Max ETF Standard, which is the full course. It's our flagship. It runs for 7 weeks. And the Max ETF Primer. So we've slightly changed the name to distinguish from the past ones. It's essentially an intro or a demo course for people that want to see what we're like, or just want a taste of what we're about. It is profitable, but it's very slow to actually make money from. The ETF Standard has got something like, we haven't really counted them all up, but just the plain standard version has something like 7 different entry styles, plus all its variants. The ETF Primer has just a couple of entry styles, and then we have ETF sitting on top of those as well. The Primer only runs for 2 sessions, the ETF Standard runs for 7 sessions, and there's a bonus session at the end of those ones as well. You'll see in the pricing later on that Craig has introduced some training bundles. So if you want to just sit with the intro courses, you can do ETF Primer and ETF Lite. Lite has an extra, a couple of extra exits and 1 extra entry included in it. So it's just a way for people to sort of get accustomed to trading. And then there's the full blown version, which runs for about 4 months for people that want to start right from scratch with the Primer and then go through to ETF Lite and then through to ETF Standard. So quite a bit of work, but really good training there. On the next page, we have, as I was saying about the different courses, so this is outlining the 2 courses we've got. The ETF Standard, its main purpose is to milk good movements. So when there's a nice movement going, we can use our profit acceleration, the scaling and the pyramiding, to get as many pips out of it as we can, and this really increases your profitability. It's got lots of exits, it can pinpoint extremes, it's got counter entry and techniques, more so than the Primer. And like I said, it's got Jim's dynamic support and resistance levels, the TTs. And then on the Max ETF Primer, its purpose is just, as I said, is an intro, a taste. I'm kind of repeating myself, but hey, it's got about 5 entries and 4 exits. It's, like I said, it's profitable, but it requires a lot more patience and care because you won't get the movements as often as you do with the ETF Standard. So here's a real quick blast. I'm not going to go through this, of what the training contents are like. This has mainly got highlights from the ETF Standard, and the way I've put this together is on the left-hand side, where it's got definition orders down to students' homework and reviews. That kind of covers what's included in the Primer course. And then on the other side, on the right-hand side, with the scale-in and extra techniques and financial risks and more entry confirmations and Jim's dynamic support and resistance, etc., that is pure standard stuff. So you don't get that in the Primer. Okay, but if you're watching this by video, you can just pause to check out some of the information there. Any questions? Nope. Okay, so once you've done the course, here's what happens afterwards. Eusebio has been doing a bonus session. So we've already said that there's standard is 7 sessions. We actually run 8. And in the last session, Eusebio walks through trade examples of a winning trade, a losing trade, and a choppy trade, a trade that's in a very, very poor situation, to show you how it actually works and it analyzes it all bar by bar. and they're really, really helpful. And we've got videos of all of them going back years now. So they're all available in our forum. On the weekends, we have practice sessions. We have them most weekends, but if you're in the primer course, then you won't be invited to the standard ones or the SAM ones or stuff like that. But most weekends we will have a practice session, and I try and include one or two sessions for the primer courses each month. The standard gets invited to the primer ones as well, because the information in there is just as relevant. And in those practice sessions, and there's no charge for them, you get to ask whatever questions you want, and we can analyze charts bar by bar. There's also a Max forum, which is pretty quiet, I have to admit, but we have a lot of extra training videos in there, indicators for different platforms like Ninja, TradeStation, and a few others that are sort of being developed at the moment, other charts, and you can keep putting your charts in there and saying, hey, I've been trading live and I'm hitting a rough patch. What's going on here? And that's a place to stick your charts, and we go through and analyze them just like it was homework. If necessary, I bring Eusebio in and we do a little video of what's going on and put that in the room as well. Occasionally, we have live example sessions. Eusebio has been regularly doing the non-farm payroll lately, and every now and then there's a major news announcement or something like that that will come out, which looks like it's going to be a good session. So we'll use that as an example to show you how the Max would handle it. We don't actually do live trading as such. We forbid it, but if you happen to, ... But we don't do any live trading as such. And in the practice sessions, you're kept up to date with any new ideas. And if necessary, if something new comes out, then I'll chop it out of the course and blast it out to the group. Happens maybe once or twice a year. The course materials are all provided. We supply all the templates and the indicators, all the videos, notes, etc. Once the course is finished, if you want to use it on your own particular platform, there's no problems about giving you the source code for MetaTrader so that you can rewrite it in your particular platform. That's how we got hold of NinjaTrader and TradeStation. Some of our Maxes ported them and then kindly gave us the code so that we can give it out to everybody else. So no charge for what we've got so far, and there's no charges for the source code. Most of our indicators are pretty standard, except for the ones that Eusebio has developed. Okay, what we want you to do is to achieve your results. So you'll end up with a rock-solid trading method. You'll have one of the most powerful trading methods that I've come across so far, and you can compare that based on the win-loss rate. It's got the trades have got good win-losses. So when you get into a trade, you've got a good chance of it turning out in your favor. The profit-loss ratio on the standard is excellent. You can really milk trends, and we have people just on the standard that have made many hundreds of pips per day, and even doubled or quadrupled in the past their accounts per month just by following the rules. These days it's a lot harder to do because sometimes the movements aren't as good, and I have to say it also depends on whereabouts in the world you are. Eusebio's in Europe, so at 8 o'clock when he wakes up, the markets wake up, and 5 p.m. each day they shut down. So he gets a really good run at the markets. It's like a day job. Here in New Zealand, the markets open up at about 9 o'clock at night for me. They will be shortly, and so I've only got a couple of hours to actually trade the London session. So it just depends on whereabouts in the world you are as to how long you can actually keep trading. I'm going to go through a couple of charts, but Craig wants to ask you a question. Yes, Craig?
Okay, thanks very much, Chris. One of the questions that we get a lot, or comment more than a question, goes something like this. You guys only show hand-picked trades that make you look good. Well, that's not exactly right. Yes, we do pick the trades. Somebody has to. but most of the trades we show you are just typical max trades. And at every webinar you may have attended in the past, you have also seen a losing trade. So we thought it might be helpful to let you see in detail how max methods perform when there is zero possibility of handpicking the trades and zero possibility of preparing the charts in advance. So today we'd like you to pick the charts completely at random. And I'm spinning the wheel just like I do for the door prizes. And if I call your name, I'll be asking you to help us. We don't want a lot of delay, of course, so if you don't answer quickly, we'll just move on. So would you locate the question panel in GoToWebinar right now and be ready to respond, but only respond if I call your name. First, I want someone to select a currency pair, any pair, maybe your favorite pair. And here's the name, Faith. Faith, would you mind helping us out? Would you please give us a currency pair, just one, in the GoToWebinar question panel? Rudolph, would you give us a currency pair, please? Are you with us, Rudolph? There we go. Okay, so our currency pair is the Euro odd, and let's move right on. We need a date now, such as 12 February 2017 or whatever date you like. And here's the name, Pam W. Pam, can you help us out with the date? Pam W. Pam, are you with us? 7 September, and we'll just assume 2017, okay? So there we go. We have the Euro odd pair on the 7th of September. And then finally, we'd like you to give us a time frame, and the name is Toter. I may be mispronouncing that. Apologies. There he is, the 5-minute time frame. Okay, so Eusebio, that's what we have, the Euro odd on the 7th of September. And if that's not a trading day, just move on to the next closest date and the 5-minute time frame. Okay, over to you.
Okay, on this page we've got a general max standard trend trade. It's a daily chart. It's the pound Kiwi. Sorry, it's a bit small. I'll have to blow this thing up. I hadn't expected it to get crushed down so much by the PDF. But this trade here shows that we've got the moving averages sitting down here, our home base and the Mo line for maxes, and we've got up in this area here, we've confirmed that there is a trend trade, and so we do an entry, we do an MX, which means a minor exit, and then we have another entry for a scale-in, and then we have a complete exit up here. We went through this in the practice session and worked this out, and the end result from this movement here was around about 3,900 pips, and we had a stop loss of 1,200 pips. We use R value, so the return on the trade was 3.2 times whatever you risked. So if you risked, say, 2% on your trade, you would have made 6.4%. Or if you'd risked $100 on the trade, you would have made $320 as a result of this trade. So this is the old version, just the standard trend trading style. And here's what Eusebio has come up with. And I've got a comparison of them side by side. Okay. So this one shows, and this is the ETF standard, and the difference is quite remarkable. Instead of waiting for up around here for the trend to be confirmed, we can start the trend getting into the reversal of the movement right at the very beginning down here at entry 1. And then there's another entry and another entry, some profit taking, another entry, some profit taking, a couple more entries with some profit taking, more profit taking. Up here is Jim's TT, which tells you you're at an extreme, so take some profit. And then we do a complete exit here because our rules tell us to. And the end result from this was 21 nearly 22,000 pips. So huge numbers of pips. Not too sure everybody would have, excuse me, got that exactly, but even if you'd missed out a couple of entries, you still would have done really well. The end result from all this, and one other benefit of the ETF, not just extra entries and being able to get into things earlier, is the size of the stop. The stop can be a lot closer than it is on the standard. And what that means is that you can increase safely, with just as much safety, your position size as opposed to what you would with the classical side of things. So the stop is actually almost, it's 500 pips, which is about half the size of the standard entry point. And it bumps the return up hugely. So your end return here is 43 times whatever you risked. So if you'd risked 2%, you'd come out with 86% in this case, and that's not unheard of. This is a daily chart, so it took a few months to accumulate that. But if you'd risked $100, you would have come out of it with $4,300. Really nice return. And the other thing which I really like here is trading the daily timeframes in the past has been kind of a chore because it took so long to get an entry and it took months before it sort of unfolded. With the ETF, even on the daily timeframes, you can get a lot more entries and be able to milk any good movements that are around much sooner, much faster. And what I'll do now is pass over to Eusebio for him to show you the rest of it, and then I'll come back and show you the pricing. And Eusebio, all yours.
Okay, thanks, Chris. So before showing the Euro Aussie, and tell me you guys and girls, you are sneaky persons because today was a terrific day for some pairs. But that's the rule of the game. You have had the choice to tell which pair to consider, and so we will go through that pair just in a few moments. Let me show first of all on this same example Chris has shown with the Max Standard how the Max Primer has done on this specific situation. So I have to switch to my MetaTrader platform because my charts are on MetaTrader platform. So here is the same pair on the same time period with the Max Primer. So the Max Primer is the first level, the first approach of the Max, and it gives you just a taste what the Max will be. And so with the Max Primer, the pure Max Primer, the classical Max Primer, we don't get a lot of opportunity to do. We need a lot of patience because we have few setups. We teach few setups. And in this example, we have, of course, the same entry here as Chris has mentioned previously with the Max Standard. And then we have an exit, a first exit. When we close half of the trade, we call that a minor exit or a momentum exit or a scale out, and then the final exit here. And then later on, some bars later, we had another opportunity to open a second trade, and similarly, with two steps, we close the trade, first of all with an MX and then with our final close. And after that, that movement was practically not tradable with the Max Primer. And so you can see that with these two small trades, which have lasted from the 5th of the 4, let me show you which day by showing the background, the 4th of June up to here, the 23rd of July, so around 1.5 months approximately, 2 trades. And the first trade happened to catch a nice trend movement. I remember it is in the daily time frame. The number of pips seems impressive, but we are in the daily time frame here. So the first unit of the first trade has got 1,150 pips. Approximately, it depends how the entries and the exit would have been made precisely. We don't need an accuracy on the pips here. And the second unit, 1,450 pips. So this means 2,600 pips for the first trade. The stop loss was a rather large stop loss, 1,200 pips, but this still represents a 1 hour, a little more than 1 hour profits this means 1-to-1 reward to risk ratio, and with a risk of 2%, for example, it represents in 1 month 2% profits. But later on, another trade, a smaller trade, because the movement was exhausting, and some of you here, I recognize some of you here in the room, you can recognize such kind of specific behavior in the price movement announcing a trend reversal. But anyway, so a second trade with, I consider typically a break-even trade because the profit was so small, but still positive. 0.07 hours. And so this shows that with two trades on the same up movement, so we got a decent reward to risk ratio with no risk at all. Now the same movement with the Max Primer and the Max ETF Primer was this kind of trades here. And so the same entry as with the Max Standard ETF, of course, but we don't have the scaling process. Simply we have an entry, then a partial exit, then the final exit here. And you can see the number of pips made by each exit. Then a second trade here, similarly with a first exit, with a loss here, a small loss. Then the final exit with a nice profit. And then later on, a third trade, also with a small profit. And so 3 trades instead of 2 trades. And it was still possible to catch some small movement here or here after this important news release. And so you can see the improvement of the reward to risk ratio. We have been able to add an additional trade, and globally with the 3 trades, so we have more than double the reward to risk ratio, 3.48 hours instead of 1.16 hours, so more than twice the result, almost 3 times the result, in fact. Okay, so this is the feature of the Max ETF, and in this case the Max ETF Primer, and you can see that we can catch the movement very early after a trend reversal, or I should say a directional movement reversal, and then very soon after, a few bars after this movement in this area, we had another possibility to catch a short trade. So this was the example Chris has just shown, and I can show them now side by side just to compare the entries in the daily time frames, and so with the Max classical primer and the Max ETF primer. So many more opportunities and larger movement most of the time. So this was for the daily time frame, and with the daily time frame we have really a very high winning rate and nice reward to risk ratio. Now let's come back to the Euro Aussie, and for that I will need to open a pair. I will go with the Euro US dollar here, and I will change the pair. I will take the Euro Aussie. It should not be easy, says Rudolph, indeed, because we had today the ECB rate statement, and then the press conference with Draghi, and whenever we have the ECB, the minimum bid rate and the press conference by Draghi, this is a time period when typically we do not trade, okay? And you can understand why we have a lot of opportunities during that time period. So it's really impossible to trade if we don't have an idea of what Draghi will say. But now let's check what has happened starting around the Tokyo Open. So in this area. So in this area, we have the price making bottom here, okay? And we have our 2 ETF lines represented by this yellow and orange line crossing up. I don't show the entire template. Here there is one companion indicator with the Max ETF, which is extremely important and which shows, in fact, a multi-time frame approach and the trend feature of the movement. But in this area, the entry setup is right here, right on this candle. And we like to display our entry setup bar with a green dashed line like I'm doing here. Okay, so this was the entry setup of this the Euro Aussie. Opening a trade during the Asian session in this chart was not was strange because we have an ASEAN currency, so trading the Euro Aussie during the ASEAN session is good. However, we have to pay attention to the news release happening during the ASEAN session. Whenever on a chart, especially when you study a past chart, you see a long bar like this one, we have to check the news release. Okay? So let me check the news today during the ASEAN session. So we were Thursday, and on Thursday we had here no specific important news release during the ASEAN session. So this long bar was due to something else, and so there was no problem to trade this entry setup because it was impossible to know that the price would have made such a long bar. Okay, and so when we have such an entry setup, we have to define where we make our entry. We have rules for that. An entry would have been made around this area. We have specific rule for that, and we would have placed our stop loss in this area, giving us a stop loss size of approximately here. You can see 12 pips plus the spread. The spread for this pair is typically 2 to 3 pips. So we have here a stop loss size of around 15 pips. And we name our stop loss an emergency stop loss. So because the aim of this kind of stop loss is not necessarily to protect the trade, but to protect the account in the case we become blind for the trade. For example, our internet connection has a problems, and so we are not observing what the chart is doing. And the trade size, of course, is calculated based on the stop loss size and the risk we associate to the trade. For example, it may be 1%, 2%, 0.5% of our trading account. So using the position sizing concept. And then once we are in a trade, we have to consider to handle the trade, and then we have to check our exit setup bar. And so we have different rules defining our exit setup bar, and we like to display our exit setup bar with magenta vertical line. Here, this red candle here is a potential exit setup bar, but the exit does not trigger. So we have to wait for another opportunity. Once you will learn the rule, you will understand why the exit has not triggered. On this example here, this red candle is also an exit setup bar, and in this case the exits triggers. And so we have in fact two alternative possibilities for that exit setup bar. Either to take the exit somewhere in this area. We have rules also to define where to make the exit, with a profit or with a loss, or to defer, to postpone that exit until we can make an exit with a profit. But this requires much more experience for our traders, and I strongly advise them in a first step when they are in a phase of learning, understanding, learning, and applying the max concept and max rules, to take the exit when they happen, even if this should be a loss. And then in this case, the loss on this first unit would be 3 pips plus the spread, let's say minus 6 pips approximately. We may have a small slippage, of course, and so we would write MX1. It would be our first exit for the first trade, and with a loss of 6 pips, for example, minus 6 pips. The entry would be here an ETF. I will not give the name of the setup, let's say ETF entry. The name of the setup is not important by itself, you will learn that in the course. And then we have to wait for an opportunity to close the second unit. And then suddenly we have that long bar, which comes from nowhere. There was no specific news associated to that long bar, and sometimes we get that. And then when we have a long bar is always a good opportunity to bank some profit. And in this case, the length of this bar has been 38 pips. Let's round it to 39 pips. And so we advise to make some profits in this area We have rules for that also, one rule. And so we define an exit level corresponding to a portion, to a retracement for a portion of the bar. And so, for example, myself, I like to take the 1/3 of the length of the bar. And in this case, indeed, the price has retraced enough and hit my exit level. And so here, I would have made my final exit for that first trade. Okay, and so this second unit would have caught approximately 17 pips. We may have a slippage, so I like to minimize the number of 17 pips minus the spread 3 pips, so 14 pips. So plus 14 pips. Of course, the movement during the Asian session are usually smaller, but this happens, of course. And so this trade, to trade number 1, so let's mark entry number 1 here. So this trade number 1, would have produced, and if you follow the rule, you would have exactly the same entry and the same exit. Small difference may be due to spreads, to slippages, and to the speed you push on the button to open and close your trade. So here -6 plus 14, so plus 8 pips, with a stop loss of 15 pips. So this represents a reward to risk ratio. So to calculate the reward to risk ratio, we have to average the number of pips because we have 2 units. So we divide 8 by 2, and then this gives 4 pips, and then we divide again by 15, which is the stop loss size. So this represents a 0.27 R, so a little more than a quarter of 1 R. This is the first trade. Once the trade has been closed, we wait for another opportunity with the max primer. And let's move this text a little on the left here, because a few bars later, in fact, here, on this candle, we had another entry setup bar, immediately on the next following bar. And this is due to the ETF. And so in this case, the entry would have been made normally somewhere in this area. But in this case, we are facing our home base, which may be a very important resistance area for the underlying movement. And you can see that the price has somewhat hesitated in this area. This is where the price has started that retracement. And so we have a rule telling us that we have to postpone our entry here in this area, here, and fixing our stop loss here, to give a stop loss size of here, again, let's say 16 pips plus the spread, 3 pips, so 19 pips. We have here a stop loss size of 19 pips. And you can see that on the 5-minute time frame, these stop losses are rather small. Not pip D, but pips with an S. I'm making typos here, I'm sorry for that. And this is the entry, the ETF entry number 2. And we are still during the ASEAN session, so after the Tokyo Open, and we have plenty of time before the Frankfurt Open, which happens in this area. Let me draw a yellow vertical line on the Frankfurt Open. So here, we like to do that to represent the main event. So we have here the Frankfurt Open, followed 1 hour later by the London Open here. And so on this platform, our time are 1 hour ahead. So London Open, I still make some typo, so Open, and Frankfurt Open. I have 2 big fingers for my small keyboard here, so Open. Okay, and so we have still plenty of time to consider all the possible trade which may happen. And so an entry happens here, and again we get a long bar here. But you can see in this example that the price has not retraced, and so no exit on this candle. And then the price print other bars, and here this red candle is again an exit setup bar, and in this case we would have had no exit triggering in this case, On the contrary, this candle becomes a blue candle, but the exit conditions, and you will learn that in details in the course, the exit condition is still holding, and so we would have made our exit somewhere in this area. So here for a nice MX2, MX number 2. So we close 1 unit. Whenever we open a trade, we consider the trade is made of 2 units, and this unit catches a number of pips of 10 pips minus the spread, so let's say plus 7 pips. Remember, during the ASIAN session, we have often small movement, especially when we are facing an ECB event. And then, once we have closed half of the trade, we wait for the next exit setup in order to have the opportunity to close the trade. And this happens with this red candle here, making our exit in this area. Okay? And so this is our XXX number 2, final exit number 2. We close the second unit of the trade number 2, catching also a small profit of also 7 pips if we consider a small slippage. And so we have 2 successive trades, for the moment 2 winning trades, and the trade number 2, so here was the trade number 1, and the trade number 2 has made a little more profit, in this case 14 pips, with a stop loss a little larger, 19 pips, and so giving us a reward to risk ratio. So we have to divide 14 by 2, giving 7, and then 7 by 19, giving us plus 0.37, 0.37R. And so with the 2 trades, we have already accumulated more than half our profit. I'm going to correct immediately the typos here. So R, and it's the trade number 2. At this point of the chart here, we still have an opportunity to open trades, a new trade. Here, this blue candle represents a new entry setup, but we don't have the appropriate conditions to open a new trade, in fact, because the price has changed its mode. We are in what we call a consolidation zone mode, and we never had an opportunity to open a new trade, and after that the price makes a small retracement. This retracement, as it happens here when the 2 ETF lines crosses downward, was not deep enough to be considered as a trend reversal, and this was given by our Max ETF companion indicator. And so at that moment, and during the entire pullback here, our companion indicator was telling us that we are still in this uptrend. And so out of question to take a short trade in that portion of the chart. And then when the price reached the Frankfurt Open in this area, the uptrend has resumed, and so it was possible so to consider a new long trade, and in fact the setup was given on this chart here with this candle 5 minutes after the Frankfurt Open, with an entry in this area. The bars usually becomes larger during the European session. We have so the entry number 3 here. We were still far enough from the ECB event. Okay, a stop loss was placed in this area for a size of around here 15 plus the spread 18 pips. So approximately the same stop loss as previously. So ESL 18 pips. And then we handle the trade. So we had an exit setup bar on this candle, but the exit level does not trigger. We make our entries and our exit exactly with the same concept. The execution is made in 2 steps. First of all, we have to recognize a setup bar an entry or an exit setup bar, and then we have to define the price entry or the price exit. And so sometimes it happens that the price does not trigger the entry or the exit. This is an example when the price does not trigger the exit, and so we have to wait for another opportunity, which happens right here. And now in this case, the price has just triggered the exit right here. And so this was our MX number 3. And it was good to make that MX, because we were approaching the London Open, and very often an important market open may be an opportunity for the market to make some retracement, and so reducing the trade size is never a bad opportunity. And here the first unit would have been closed with a small profit of around 6 pips. So 6 pips here. Today was really a small day with very small movement due to the ECB. And then we had to wait for the next exit setup, which came in this area. I have to check carefully because we have several types of exit setup. We have exit setup based on indicators. We have exit setup based on the price action itself. But I am in the max primer, so I have to pay attention here. So we have an exit setup, but the price does not follow through. And then we have another one here, and here the price follows through with an exit in this area approximately, making our XXX number 3. XXX number 3, for a partial profit here for this unit of around, you see, let's say 14 pips minus the spread, 11 pips, so plus 11. And so now we can write on the chart here the third trade. Let me move these comments here closer to keep them under our eyes. And so the trade number 3, would have given how many pips? So 11 and 6, so 17 pips. Almost scalp trade in this case. The stop loss was 18 pips. So just a little less than 18, a little less than half hour. And so 17 divided by 2 and then divided by 18, giving 0.47, so 0.47 R. At this point, let me check on my more detailed chart I have on another screen here, because I'm not showing the entire template. At this point, in fact, with that exit, we are now switching into a down movement. On this point, our companion indicator is showing us that the trend is reversing. And then we can engage into short trade. And so it happens also that at the close of this candle, which has triggered our exit, this would have been also a potential entry setup bar for a short trade, with an entry in this area, a stop loss here. So the stop loss side would have been a larger one, let's say 24 plus the spread, 27 pips. ESL 27 pips, so a larger one. And once the trade is opened, we have to look for exit setup bar. And we had a very nice exit here based on the price action here and on Jim's support resistance level, which gives very, very accurate exit. So here we had a nice exit setup. And so we had our ETF entry number 4 here, so 4 trades up to now, 4 trade, and a nice MX number 4 here, MX number 4, okay, for a profit, not a big profit again. See, 14 pips minus the spread, 11 pips plus 11. And then we are waiting for the exit of the second unit, which happens, in fact, Let me check carefully where it has happened. It has happened right on this candle and an exit here in this area. And so the trade is closed here. Exit number 4. Also for a small profits, we take what the market allows us to take. You see, let's say 4 pips minus the spread, 3 pips, so just 1 pips, plus 1. And so we can conclude our 4th trade here. Trade number 4. $12 pips plus 12. A stop loss of 27 pips, so the reward to risk ratio will drop, of course. 27, and it will drop to 0. So we have to take 12 divided by 2 and then divided by 27. So 0.22 hours. A little less than 1/4 of 1 hour. And then we are in this period entering into the lunchtime period in Europe, facing the ECB. So in this time period, it is advised in our trade risk management approach not to trade. However, it would have been possible, for example, to trade this movement short and to catch that last movement before the news release. But with the ECB, we never know. And during the lunchtime period, we don't like to open a trade facing the ECB. And after the ECB, usually my day is over, especially when Draghi has explained that no change has been made, and he has to expect further analysis and further evolution in the economy to decide what to do, but especially deciding to continue the QE up to the end of 2017, this year, and possibly later. However, during all that portion of the day after the ECB, trade was to the short side, and so we had an entry set up here. So it was the only trade available for the end of the day. No, that's not true. We had the possibility to trade also that long trade, but this was during the end of the day. And so personally, usually I don't trade. I don't trade during the second half of the US session. But the last trade available during the European session was here. Oops, not in yellow, but in green. So here, this one, with an entry right here. And the entry was not valid because, again, too close to our home base. So this trade was not a valid trade. It would not have been taken. So we have rules telling us when a trade should be skipped. And so today was a very difficult day, but we had only during the ASEAN and the European session 4 trades. It happens in this case that despite their small result, they have been all winning trades. And this is due to the fact that we are able with the Max ETF to identify the correct bias most of the time. Of course, sometimes we will have losing trade. We don't have a 100% winning rate. Of course, this is almost impossible. But in this case, despite the difficulty of the day, 4 trades and 4 winning trades for a total of, let's write the total here. And you will see that even with the Max primer, we can get safe trade but decent results. So we have 8 and 14, 22, 22 and 17, 39, 39 and 12. This represents 51 pips, I think. Let me check. At this time of the day for me, it's almost not too far from 11 p.m. It's become a little late for me to make a mental calculation. Plus 12, so 51, yes, so plus 51 pips. But the number of pips is never relevant by itself. What is much more relevant is the reward to risk ratio. And if we use the same risk per trade, for example 1%, a very easy way to obtain the total result of the day is to add the reward to risk ratio. So plus 0.27, plus 0.37, plus 0.47, I have to start again, so 0.27 plus 0.37 plus 0.47 plus 0.22, and so 1.33 R. This means that with a 2% risk, this would have produced a profit of 2.66%, and with a 1% risk, this would have produced a plus 1.33% profits. Okay? And of course, because the max is a trend following system, when we have small trends, we have small results. When the trend is larger, we get larger results. But the reward to risk ratio are still decent, because with the Max ETF, one of the great advantages of the Max ETF is usually, not really, but very often, usually, we have smaller but safe stop loss. Okay?
Eusebio,
Yes, Chris, please.
a couple of questions. From
Yes.
the bottom of the movement to the top,
Yes.
not the ECB, but how big was that movement? So, and how many of those trades would the regular primer have taken?
Okay, so from this bottom
Yep.
here to this top here, the movement was 82 pips.
Okay.
And what was the second question?
How many would our normal primer or even the standard have taken of those trades?
Okay. With the primer or with the standard, we would have had, let me check, we would have had a max setup here. So this would have been an entry setup with an exit in this area and an exit in this area. So just one trade. And then the second trade would have come here in this area. So only two trades. Only two trades.
And quite small profits as well.
Yeah.
That was a really difficult chart. Yeah.
Yeah, it was a difficult chart, indeed. Many pairs today have been, so many pairs with the euro have been difficult pairs today, indeed. But there has been some other pairs with nice movement. If you take some yen pair, for example, the euro yen, the USD yen has been really nice today.
Yes. I was kicking myself making the presentation when I saw the euro dollar at the end of it. So, trading is much more profitable than training. Anyway, okay. Anything else, Eusebio? Thank you very much for that, though. It was excellent.
Yeah, what I would like to show also is how we can use, in combination with the Max ETF, standard or primer, the max price levels. And as you have explained, so every weekend I produce the max price levels for around 20 pairs or 20 instruments, including some indices and gold also. And so I sent a zip file, and that zip file contains a template per pair. And so once the template have been installed in the MetaTrader platform, what we can do to integrate these levels on the chart we are trading, we can open a naked chart. So here it is the Euro Aussie. Where is the Euro Aussie? Here. The Euro Aussie is right here. So I open a naked chart, and then I draw my levels here for the Euro Aussie. The Euro Aussie is almost always selected, and you can see the max price level. And it happens today that the price has not reached the levels except during the Asian session, when the price has started not too far from this lower level. It was at 15 pips, and so it was logical to take long trades here, at least until the ECB. And after that, the price was in the middle of nowhere, and so technically both long and short trade were available, but we had to consider the global trend the price is doing, and this is what our companion indicator will indicate. And so if you want to have these levels on the chart you are trading, you have just to use a script we use, which is called copy object. And so we drag and drop that script on the chart. We can use also hotkeys. I have defined, for example, Control L as the hotkeys associated with this level. I have pushed on the Control L button. And if I come back to the Euro Aussie pair, now we will have, in fact, the levels on the chart. And when the price reaches these levels, we have to pay attention. These levels have been drawn last Sunday, last weekend, and you can see during the Asian session here today, yesterday, the price has touched that level and you can see how the price nicely respects this level when it approaches these levels. You see here. And so small movement, but still profitable trade with the Max ETF. Let me just give you a small preview, and I will stop here, of our companion indicator to help trading with the Max ETF. It is only a portion of the Max ETF because we have also a multi-time frame approach. But the problems many traders have is to try staying as long as possible inside a movement. And let me show for that a pair with more activity. It will be a little more enlightening. So we see here that we have an uptrend, okay, followed by a nice retracement starting a downtrend. And so the companion indicator, the final companion indicator, is still under development. It still requires some work to refine it and to make it faster, because it requires a lot of calculation. But in the meantime, I have found a proxy which is an indicator making approximately the same job nicely, and which will be enough in a first step. I will not give you the name of this indicator for now. Some of you will perhaps recognize it. It is a multi-time frame indicator. I will not give the name. I have temporarily renamed it as the Max ETF directional bias, because it would be too tempting for you to try downloading this indicator and use it. But if you don't know how to use it, you will have some disappointment. And so in this area, before the ECB, we can see that, in fact, I will not give you the rules of the indicator, but during all that period here, the indicator was showing that the bias was to the upside, up to this area approximately. And so all that movement was a directional movement, and you can see that we catch the entire movement, despite that sometimes the price is making a pullback. Of course, we have to skip the ECB, but once the volatility settled down, for example, in all that area, now we are here in a downtrend. This is a downtrend, up to this point, exactly to this point, approximately here. And so aiming to catch all that down movement. And then, nicely, despite that pullback is considered by the indicator as a small pullback, not setting the longer term trend into a danger, and then switching back again to a long trend. And so we can switch from long trend to short trend. See here, all that movement starting in this area approximately up to this movement was a short movement. And so with the Max ETF, you would have had a lot of opportunities to make trades along that downward, taking only short trades. And before that, we had here a small time period starting here with an upward bias helping to catch that movement here up to that point. And so on and so on. And so either you have small movement or large movement, that companion indicator helps to catch these movements in a very, very, very efficient way. And in the course, I will, and this is true in every time frame, by the way, okay? And so we use 2 time frames here, but we can use any time frame we want, but 2 time frames are enough. And the idea is to use also what is happening in a higher time frames in order to stay in the movement as long as possible, avoiding the temptation to close a trade too fast, too early, when the price is making a pullback. Because, of course, the uncertainty we have when the price starts a pullback is we never know how deep the pullback will be. And many traders will fear to stay in the trade when they see the price pulling back. Because while the price is pulling back, of course, a portion of the profit, the potential profit, is disappearing. But if that pullback does not change the nature of the trend, we have to develop that culture to stay in the movement and in the trade, and this is why we are developing that indicator. So not this one. This one is one which is available publicly, and I will give all the details in the Max courses, of course, but the final indicator will be a custom Max indicator and it will be even a little more powerful. Okay?
Really nice, Eusebio. One of the questions that continually asked is, what's the bias in the market? Should I be going long or should I be going short? And just by looking at the news events and trying to understand what's happening globally, it's really difficult to figure out the bias a lot of the times. So
yeah,
really helpful.
Indeed, there are, for me, two ways to look at the bias. Either by looking what the price is doing, and we can see that for the moment the price is in an uptrend, and there is no reason for this pair, for example, the euro-yen on the 5-minute time frame, not to continue upward. It may reverse, of course, but for the moment I don't see a sign of weakness for the upside, and so that entire up movement would have been tradable. The second way to view the bias is through the news release. And indeed, if I come back to the calendar here with our news watch list, we can see that for tomorrow, Friday, we have some biases on some currency. For example, on the pound, up to the manufacturing production month-over-month news release, I consider that we can be bullish on the pound. On the pound, the currency, not the pair, on the pound. And similarly, bullish on the CAD until the employment and the unemployment rate. And so this comes from the sentiment in the market induced by the news release and the forecasts made on these news releases. And so this is an entire subject, how to define the sentiment in the market based on the news release, and we teach that also in details, how to define the fact that the bias is bearish or bullish or neutral. And so this can help to define the direction of the trade to take. For example, if you decide to take the trade until the news release for the pound, you take for example the pound yen, the pound US dollar, it's better to consider only long trades. And once the news release has been made, depending on the news release, the bias may change. It may become bearish. For example, if we have a very bad news release with a big negative surprise, then the bias will be changed to bearish. This is what I can say, Chris, on that subject.
Thanks, Eusebio. And some of our Max people in the Max chat room are asking, how can we get hold of this? Craig has sent out information about how to get yourself upgraded to the ETF version if you have not already. The ETF has been taught as a separate course lately, and so we're incorporating it in the primer and the standard right now. So if you haven't done the separate course, then in order to learn this, how to use the ETF and get hold of this indicator, Eusebio will be doing the training for the primer and the standard courses starting this weekend. Where am I going? And for Maxes, when you take a course, you can retake the course at about 25% of the initial price, and for about 4 times, and then it's free repeats forever after that. So I've had people that have taken 30 courses at no cost kind of thing. So if you just simply retake the course, I think it's about 50% again off a retake price. The information is in the emails that Craig has sent out. So we're making the upgrade at a very affordable for you to get into it, so you can take advantage of this ETF. And as you can see, you get much longer, many more movements. In Eusebio's, what Eusebio showed us here was 4 or 5 different entries in the one movement, and a lot more chops at the market and longer movements as well, not just sort of quick, brief chops at the market based on the trend movement itself. Okay.
One last point I would like to mention, Chris, is also we have another tool, which is not a free one, but the price is really cheap. And this tool has the aim to never miss potential opportunities. And you can recognize with these 2 ETF lines that whenever they cross, we may have possibly an interesting situation to analyze. And in order to never miss these opportunities for any pairs you want to follow in any time frame, we have an indicator. Let me show you that quickly. We can open a chart, any chart. The chart is not, the pair is not important. And I have a template showing that indicator, which is called the dashboard. And I'm going to show the dashboard for the 5-minute and the 15-minute time frame. So it will take just sometimes to update because it has a lot of calculation to do. And so we have a lot of alerts too. And so in this example, it shows the 28 pairs made of the main 8 currencies on the 5-minute time frame and the 15-minute time frame. We can change, of course, the list of the pairs. Here we have the list of the pairs we want to include. We have the time frames we want to. For example, I can include also, let's say, the H1. H1. I have to add a small parameter here, but which will not be used for the moment. Let's say 200. And if I click on OK, the 1 hour time frame will be also included. And so it takes a few seconds to refresh. And so now we have information about all the pairs in the selected time frames. And so if I consider, for example, the OZ CAD here on the 5-minute time frame, the arrow, when it is a green up arrow, it indicates that the 2 ETF lines have crossed upward. When it is a red down arrow, it indicates that the 2 ETF lines have crossed downward. And the small number following indicates how far in the path the 2 lines have crossed. For example, here on the OC card, they have crossed upward 3 bars ago. On the 15 minutes time frame, they have crossed upward 4 bars ago, and in the 1 hour, they have crossed downward 16 bars ago. And we have several types of alarms. We have a pop-up alert with all the events happening. We have also a sound alert. It's possible to send an email, of course, if you are not in front of your screen, provided you have parameterized correctly your metadata platform for the emails, and so on. So in this case, you can have an alert whenever an interesting situation is developing. This does not necessarily mean that you will have a trade. There are simply situations you have to examine for a potential trade, but you will, if you explore them carefully, you will not miss these opportunities. But this indicator requires a lot of resources, so you need to have a good computer, a good PC for that. So, okay, I'm done, Chris. So up to you now.
Thanks, Eusebio. And that indicator, sorry, Eusebio, back to you.
Yeah. No. Go on.
Okay. That indicator is available in the ETF sub-forum under indicators and then alerts. It's made by outside programmers and they charge a bit of money for it. So Max says you get a cough up, sorry. But there is a single pair version available which sits at the bottom of the charts for that information. Can you go back to the presentation, Eusebio? So yes. Does anybody have any questions about what Eusebio has just gone through before we chop away from it? We're taking a bit longer than kind of expected for this presentation, but it was really nice to see Eusebio go through that stuff. Thank you. If you do have some questions, we can come back to it, but rather than wait, let me come back to here and see if I can change. Yep, I can. So what we showed you, and in the first page, first example, I showed you something like 29,000 pips from a daily chart. You don't necessarily need to get these large numbers to be successful. If you're trading every day, and like for instance the 5-minute chart or even the 15-minute chart or the 30, it's consistency in the process, not the consistency in the wins that's the key thing. So we'll, Craig, if he hasn't done it already, will be sending out a spreadsheet which shows the effects of compounding. And rather than bring the spreadsheet up again, here's an example of just 25 pips. If you can produce that on average a day, and you do it for a year with a 20 pip stop loss, and with ETF it can be tighter. And if you're just risking only 1% of your account, so if you've got $10,000, it means that if things go really bad and everything hits your stops, you only lose $100, 1% of your account. And incidentally, I have to say that the way that Eusebio's changed our money management with our invalidation zone stuff, it means that if, on average, if a trade goes bad, then you will, even though you've got a 1% risk totally on your stop loss, on average, the worst that you could do is about 0.5%, half of that, whatever you're risking. So we're very, very careful about our money management. Account protection is everything. We don't really care about the profits. We're more caring about protecting your account from poor entries and stuff like that. Okay, but just 25 pips a day with a 20 pip stop using 1% risk on your account will grow the account by 4.5 times that year. Doesn't sound like much, but if you then plow that back into the next year, it's 47,000. And if you do it for the next year, it's 220K. And if you look down in the bottom corner here, just as a reminder to me, if your stop loss was 15 pips instead, then this would be $79,000, not 47. And this turns out, so it doubles this amount pretty much, and it triples this amount almost. So just a few pips a day is enough. And when you're using ETF standard with the ability to scale in, then these sorts of numbers can be hit much faster. You don't need to trade as much perhaps, but you still really, really important thing is the consistency. You have to follow the process, follow the rules, and not bend them. Okay. How much is the cost of the optional ETF alert? Kurt, there's no charge for the single ETF alert. I can't remember what the cost of the one that Eusebio showed up there on the screen. I don't think it's that much. Okay.
Chris, I think that for the dashboard, if I remember correctly, I have to check with the coder. I think it should be 79 or 89 euros or dollars, something like that.
I think it's under $100. Yeah, sure.
But the single alert is free indeed, because we have a simpler version of the indicator.
Okay, and so everybody that takes the ETF will get access to the one pair alert. If you want the multiple pairs, then that will charge. Okay, so pricing, and then we'll give the course away, and then we'll answer your questions. So still a bit longer to go, but not that long. The ETF standard, our flagship, the one with all the extra entries, tighter stops, profit acceleration, able to scale in, Jim's inventions, the TTs, really, really nice stuff. Starts on Sunday, this Sunday the 10th at 4 p.m. New York time. Normal price is $3,000. We've got a webinar special still running at $2,399. And if you ask Craig very nicely, he might be able to let you drip feed it. I'm not too sure, but surprise, Craig. You're drip feeding them now. And Craig has also put together that training deal, package deal, with the primer, the light, and the standard, all using ETF for $2,679. And the link is there, and I think Craig will be putting it up in the chat room as well. We'll be sending it out by email too, so they're available for you. So it's really involved. There's a lot of detail in it. It takes a lot of time to go through the courses and to get up to scratch with this, especially these days with the tight ranges. You have to be really precise about what you're doing. So, okay, we put as much into this stuff as we can. The ETF primer, just an intro course for beginners, 2 sessions, about 6 hours of training, probably a bit more, definitely more than that. It's slow, but it is safe and it is profitable, but you don't get as many entries out of it. It starts Tuesday in about a week or two's time. It only runs for 2 weeks. It is, like I said before, a bit harder to learn because you don't have as much, you're not immersed in the course as much. But the regular price is $329. Our webinar special is $159. And Craig has put together a package of the primer and the light, so that's a couple of months worth of training for $759. All the courses have wait for the page. All the courses have got homework associated. You're invited to your appropriate level of the forum afterwards. You'll have access to all the indicators that pretty much have been shown here today. So they are complete packages in themselves. There's nothing else to get once you get these. And if there's any questions, please let me know. Okay, what's the minimum size dollars to start trading with?
It depends, in fact, what markets you want to trade, because of course with the Max you can trade also the futures market with the currency futures contract. And you know that there are specific margin requirements. The minimum size you can trade in the futures market is the contract itself. And so usually it is considered that in the futures market you need a minimum trading account of around 2,000 to 5,000 US dollar, or the equivalent in euro or in any other currency you want. With the Forex, you can start trading also with $2,000. A smaller trading size, it's way more difficult. You will get also the same result, but the profits will be small in terms of absolute amount, and so it will require a lot of patience to grow your account. But an ideal minimum trading account for me is around 5,000 US dollar or euros.
Okay, thank you. Randy has just asked, is there a need to, there was something really important I was going to say, it's gone out of my head. But Randy was going to ask, is there a need to has asked, is there a need to take the primer and the light if you're learning the standard? And the answer is no. If you're really beginning, then I recommend taking up the primer and the light first, because it'll gradually get you into things. But if you're already sort of trading, then everything that the primer and the light teach is included in the standard, plus a lot more. So the primer is just there to give you a taste of what the standard is like, so you get some idea on what we are like as well. Okay. Somebody has asked, are pivot points viable? And I guess the closest thing we've got are the price levels, and they seem to work, but I don't know about pivot points themselves. Eusebio?
I have no specific experience with pivot points, except some types of, some categories of pivot points used by banks. There are banks levels also, and these are working nice. But for the moment I do not include them in the max price level. Some days perhaps I will include them. But the usual pivot you have perhaps in mind, I have no idea, I don't have experience. I always try to link my trading process with some concept used by the big boys, in fact.
Okay, thank you. Someone has asked, I want to turn $200 into $200,000 in a year. How can I do this?
It's not impossible. It's not impossible. But you will need to trade every day. You will need a lot of discipline, a very strong discipline, a total discipline. Let me just tell you a small anecdote. Around 10 years ago, when I was still living in the area of Paris, a friend of mine has learned to trade Forex with also a scaling approach. And he has started with an account of 5,000 euro. And in 1.5 years, so he has grown his account to 750,000 euro in 1.5 years. So it's not impossible.
And somebody said, I am scared of putting money into the market. I've lost money before, and now I'm too scared to get back in. How can I get over this?
So you need to understand why you are scared to put money in trade. One of the main reasons I observe day after day after day with many traders is, in fact, there are two facets in their fears. First of all, they are over leveraged in their trade. So they use too much risk in each trade. It is often considered that a 2% or 3% risk per trade is reasonable. Frankly, for me, 3% is too much, even if you have a complete mastering of your trading process. 2% is still acceptable, but personally, for me, this is my personal choice, it's still too much. I prefer to trade with a 0.5% to 1% risk, because this level of risk I feel completely comfortable, and if I lose several trades in a row, I don't feel hurt. The second reason for fears in the market is the uncertainty. When we open a trade, we don't know the right side of the chart. And so we cannot predict for sure what will happen. And that uncertainty creates problems. And if you force trade, if you don't follow a trading plan, if you don't follow a concept and rules which are time tested, then you will have more losing trades than you can expect to have. You will have losing trades. Even if you have a 70 or 80% winning rate, you must still expect to have between 4 and 10 losing trades in a row sometimes. Between 4 and 10 losing trades in a row, even with an 80% winning rate. And so your money management and your trade risk management must be developed in such a way to survive these possible and certain losing streaks. And this is key. Once you know that your trading process allows you to nicely survive these events, negative events, then believe me, you will feel much more comfortable in trading. But this is something you have to learn how to do.
Well, okay, this one's more statistical. What number of trades do I need to do to give me a reasonable expectation that the past will reproduce itself in the future?
For me, this is not a question which is relevant, not completely relevant. But what I can say is, if you want to have a good idea of the quality of your trading, or if you trade perfectly your trading process, the quality of your trading system, you need to have a sample of minimum 200 trades. If you have 200 trades made under the same rules, the same context, this will give you a good idea of the performance you can get, you as a trader, using that trading system. It's not necessarily the performance of the system itself, it's your performance, because when you will trade following a specific system, you can make errors. And so you have to make the difference between your personal performances and the system performances. It's only your personal performances which count at the end of the day. So to have a good idea, a minimum size of the sample is 200 trades.
Okay,
with 200 trades, you will get result with an accuracy of around 10%. If you want a better accuracy, for example 4 to 5%, you will need a sample of around 500 trades.
Okay, cheers Eusebio. Another question is, they say one shouldn't get into the trade at the top or at the bottom, like getting in at the top and trying to go higher. How do you determine where the top is?
I don't define where the top is or where the bottom is. I don't try to catch the top or the bottom. I simply follow the rules. And so the template we apply to the max gives us the rules, when to enter, where to close the trades. And so we don't try to catch a top or a bottom. Of course, our ETF lines have the aim to reverse as fast as possible after a top or a bottom. They still have some lag, of course, but the lag is really very, very minimum. Then, the companion indicator, which take into account higher time frames, tell us if the top or the bottom we are looking for is a good one to initiate a trade or not. So if we pinpoint a top reversal, we will be looking for a short trade. If we pinpoint a bottom reversal, we will look for a long trade. And the max price level may help also to observe where price can reach some obstacle or some resistance area during its movement. The fact that we have a max price level does not mean that the price will necessarily bounce off of that level. It may cross that level without any problem, but it will be a place where we will have to be much more attentive to what the price is doing in order to manage the risk associated with the trade.
Where hardest thing I find about trading is finding a system and sticking with it. At times I make trades because I'm anxious to get in, and then it goes against me. Another person has said, I've lost confidence and I can't find anyone or anything that I can trust. My biggest concern is being available when the opportunity is there, and more importantly, dealing with the fear holding me back. and how do I mentally prepare for trading to eliminate emotion, to have emotion-free trading? Lots of big questions there. But,
Yeah, go on.
go for it. No, it's, I guess the last one, my biggest question is, how do you gain confidence to successfully trade continually? I've been able to overcome fear and trust the system with real money.
Okay. There are several points you have to be attentive, and this will answer most of the questions. First of all, you have to consider a risk which is appropriate to your personality. And in the Max, we have, through a mini course, a procedure helping each trader to define the optimal level of risk each trader should use. And the risk for one is not necessarily the same risk for another one. One trader will feel comfortable with a 1% risk, and another will feel comfortable with a 0.5% risk. And so the appropriate risk level is an important factor solving many of the psychological level the trader may have. Most of the psychological problems comes from using a too large risk per trade. And of course, I have also explained the uncertainty. But the uncertainty can be mastered through the process. You have rules to define when the price is trending or counter-trending. You have rules to show you how to exploit these movements. And so just apply the rule with discipline. And so this helps also the psychological problem. Concerning the emotions, I am against the idea that we have to control our emotions or to suppress our emotions. I don't agree with that idea. We are human beings and we are always experiencing emotions. And the emotions, when you analyze them, can be extremely useful. What you have to control, however, is your actions. It's your decisions, despite your emotions. Control your action under your emotions. In my example, for example, when I feel somewhat uncomfortable when I open a trade, because sometimes I feel uncomfortable, then usually the trade will be a good trade. If I feel totally comfortable when I open a trade, usually this would be a losing trade. And so I pay much more attention. And this comes from the emotions I'm feeling. And so the fact that I use my process with discipline and I use the appropriate risk level for each trade, I have no psychological problems when I trade. Because I can sustain, for example, 50 losing trades in a row without hurting my trading account. 50 losing trades in a row. When you get such level, I don't understand, should you have still psychological problem?
How do I find out a right trading strategy that's got a good success rate? How do I know when the trend is changing? And I want a successful trade entry point better than 90%. How do you identify that? And how do you know when the trade's going south? And how do you know when to enter the trade? And how do you add to a position? This is what we do the trading for. So
yeah, indeed. Let me tell you something. If you consider a good trading system is a trading system with a high winning rate, you are completely wrong. You may have a trading system with a 90-95% winning rate, and this system will miserably fail. And I can show you a trading system with 30% winning rate, 20% winning rate, and which will create a fortune. The winning rate is irrelevant. It's not a measure of the quality of a trading system. You have to take into consideration the expectation of the system and the frequency of the trades you can make with that system. This is the key. And considering that, you may have a lot of good trading systems. And by the way, a good trader can make profits with a trading system which is considered not a good system. A bad trader will make losses even with a good trading system. And the reason is the discipline and the process. The consistency is not in the winning rate of the trading system, it's in the way you apply the trading system and its concept, its rules. Now there are several philosophies in trading system. You have pure technical approaches, you have fundamental approaches, you have macroeconomical approaches, you have value approaches, you have a mix of all these concepts, but there are a lot of good trading systems.
This is what the training course is about, to show you where you can expect to get high accuracy entry points. Better than 90% generally occurs only on higher time frames, like dailies or something like that. But we still have really good entry points. And as you saw today, the ETF, adding ETF to this will give you a really good indication of which way you should be trading. And with Eusebio's new companion indicator, will give you a really good idea on the bias, so that you know that you're taking a trade with a really high chance of it turning out for you.
Yes,
Okay.
we have, for example, whatever the time frame we use, we have one of our indicators, for example, help us to define if a scaled, for example, becomes risky or not. When we use a small time frame, we have also timing consideration during the day, which help us to understand when a scaling is risky or not, and if it is risky, if it is better to skip it. So yes, the trade risk aspect, the risk aspect is very, very important, and this is make a big difference in order to be successful with a trading system.
Okay. Thank you. If there's no other questions, let's wrap this up. Thank you very much for the people that asked the questions. Hope we answered them. If you do have any more, please send them in. Our contact details are there. Also available some of the time on Skype. Just depends on if we're at lunch or asleep or something like that. But hit us up. I recommend that you take the ETF standard, because that has it's a complete package with the scale-ins and extra entry confirmations and exits to help you really milk the trends and get in early and sit with the price and get as much out of it as possible. So thanks everybody. We're off the air.
Yes, I will close the site, the GoToWebinar in 5 to 10 minutes. So bye everyone.
Cheers.